Good evening, friends. How are you doing? Is audio okay? Shall we start? Good evening, everyone. All good? Audio is good. Shall we start? Good evening, Sarvana. Is audio okay, everyone? Okay, wonderful. Let's start. So we'll start today's session. Today's session, I'm going to keep it today's session and tomorrow's session. That means for 23rd and 24th, I'll keep it very light session because this is the first time we are doing it. First 2-3 classes I'll keep it very low paced, very slow paced in that case, so that everyone get used to it, and gradually we'll scale it up. In that case, the level of the classes will scale it up. In that case, in totality we are having 100 hours for our classes. That includes the revision of almost 10 hours. So that means we are having 90 hours of the classes and 10 hours of the revision also. Good evening, Shetty. So we are having total 100 hours in that case. So we have to consider in gradually we have to scale up the speed of the classes also, because we have the target to finish in that case also. Okay. Since it is the online classes, 2-3 things I want to discuss from you. First of all, do you need to come prepared? That means, do you need to the preparation before coming to the classes? Absolutely not, right? Because clean slate is much better than the dirty slate. Come clean slate. You do not need to revise. You don't need to read anything. Just come clean slate, right? That's my responsibility. I'll make you understand everything in that case, right? So come without preparation. So this is something which is not required to be done. Second thing, what I need from you is whatever we have done in the class, after the class, please revise that. That would be very helpful in that case. That whatever, once we are done with the classes, once we are done with a particular class, you get the full day next day. Please revise whatever we have done it, so that it is going to be absolutely good for your understanding. And the whole approach is, by the time the batch is over, right? By the time the batch is over for us, you are already done at least 2 rounds of revision in that case. And maybe with the gap of the 10-15 days, you can actually write the exam also. So if you are continuously revising, in that case, we will do multiple MCQs in the class only. We'll do the essay writing also itself. So you will be pretty much prepared in that case. But if you're not revising it, it's just no point, right? Because by the time the batch is over, you have to do everything on your own. So let's try to revise. Let's try to finish at least one time within the classes itself, right? So I'll keep on with a gap of 1 or 2 weeks, I'll keep on doing the regular revision in that case, so that ensuring that we are on track. Are we revising properly or not? So I'll ensure that thing. We'll continuously keep on revision as and when the classes are going on. So revision is one thing I want from your side. Second is, since these are the online classes, unfortunately we can not switch on the mic, because the recording of the same is going on, and it's for your good only, because you can see these recordings later on as your convenience also in that case. But I want from your side is more engagement in the class, right? Because it's a online classes. I just cannot see whether you're understanding it properly or not. So whatever the question I'm throwing to you, please be involved in that case. Please be engaged in that itself, so that if you have any questions, I'll get to know that this is the problem you are facing in that case. This is where I need to give you more explanation in that case. So please be engaged in the class. Whatever the question I'm throwing to you, be responsive of that, right? Please be, we have the only way of responding through a chat, so please be responsive on that case. That would be something which is going to be amazing. All right, can we have a better engagement, everyone? Yes, no, maybe. Okay, thank you, Shekhar. Okay, with the engagement we are just going on. Vijay, thank you so much. Okay, anyone who has never done finance, anyone who has never done accounts, or might have done it but it's been quite a long time? No? So each and every one of you have done it somewhere. Okay. You are working in that area, right, Shetty? You are saying it, Shekhar? You are saying it, you are working on that. Sure, Ashok. So it's okay. So Ashok, wherever you face any problem that this is something which is going over my head, I could not understand that, please. uh, sure, Sarvana, absolutely okay. So please stop me, Sharvana, stop me, Ashok, wherever you face any problem. If you're not able to understand, don't worry about this. We'll do it 20,000 times. Don't worry. Make sure you are understanding that. Savannah, it's going to be absolutely okay. Don't worry about this. Once you gear up, right? Once you become regular, right? Once you keep on revising, you'll pick it up. Don't worry about this. That you're starting after very long. Don't worry about this. You'll pick it up. Don't worry. But keep asking the queries. If you are not clear about anything, please ask the queries. Don't worry on that. Okay. Okay. If we make the accounts or if we make the financial statement, how many primary statements? How many statements do we make? How many statements we make? How many statements do we have in finance? Yep, we have 3 statements, correct? First is going to be P&L, profit and loss. Second is going to be balance sheet. Third is going to be, which is the third one, Sarvana? You can post on the group so that for everyone's reading, don't worry about this. Cash flow statement. Again, a very important statement, a very, I would say, very understated statement. If you ask me personally, I think the cash flow statement is the most important, right? See, think yourself, right? For example, if you are running a business, right, would you care about that much about how much is the depreciation getting charged, how much is the amortization getting charged, or you're worried about how much cash I have earned, right? As a business owner, right, we only worried about how much cash we are having. No matter my profit is 1000 crore, but if I'm not getting that in the form of a cash, it has no meaning, right? You see all the big banks, right? SBI, PNB, they have given the loans to so many who's and who in that case, but are they getting their money? No. So initially your balance sheet look good, right? But eventually when you're not receiving the money back, when you're not receiving the cash, it is no point in that case. So cash is only the most important aspect in that case. Correct. Absolutely, Vijay. That's a very, very important and the crucial aspect is the cash in that case. All these 3 statements, everyone, are these for the full year? All the statements, are they made for the full year? My question is, do we make all the 3 statements for the full year? Okay, it's not a trick question. We make it for the full year. So P&L, we make it for the full year, right? Or whatever is the period, right? So in this case, generally we follow the calendar. In US, we generally follow the calendar year. Everyone, we follow the calendar year. Calendar year means any period which is ending on 31st December, right? So that means 1st January to 31st December, US we follow it in that case, right? January to December, we are going to follow it. We don't, when we say, we don't call it the financial year, everyone. We don't call it the financial year. We don't call it the fiscal year. No, we don't say it. It's no March to April, though there is no restriction that you can't follow it, but majority of the cases you will find that it is going to be the calendar year only, right? Though they have the freedom, they can follow the other methods also. For example, Walmart follows from January to how much, January, February, March to next January, they follow it in that case. So everyone is free to do that, but generally you will find a calendar year only in this case. Okay. So even in the questions, we are going to continuously use the calendar year only, because accordingly you will be well equipped for that. So you're right. P&L is for the full year. Similarly, the cash flow statement is also for the full year. If I ask you balance sheet is also for the full year. Is it also for the full year? Okay, let's see that. Balance sheet, what do we write in the balance sheet? We write, these are my assets, right? This is my cash. This is the inventory I have. This is the plant and machinery which I have, right? These are the things I think we write in the balance sheet. Here we will write, this is my equity share capital. These are the liabilities which I am having in that case. This positions, whatever is coming here, this position which is coming, is it for the full year? It is as on date. It is as on date. Right. It is going to be as on date in that case. What is the meaning of that? For example, if Shekhar, I come to you, right, and if I ask you, Shekhar, how much cash you are having, right, you will say, okay, I have, let's say, $100, right? So I come to you on 23rd of April 2022, and you say that I have $100 right now. Okay. If I come to you after 5 days, right? So if I come to you on, let's say, 28th of April 2022, will you still have $100, Shekhar? Will you still have $100? No. The position might change. You might have more money. You might have less money in that case. Correct. You might have same, may not be, would be changes in that case. So that's why the position which is $100, the position of $100, it is as on date. This position is only for 1 day. Balance sheet, whatever we make it, it is as on day. That means it is only 1 day position. It is only 1 day position. Is this point clear? Which is that day? Beginning of the year? Middle of the year? What is that 1 day we are talking about? It's end of the year. It's end of the year. So if we follow in the calendar year, we will make it for 31st December. We'll make it for 31st December. So if we look any balance sheet, and if we say that this is the liability, this is the cash in this case. So if we see any balance sheet, which is going to be on 31st December, let's say 2021, and the loan is appearing, let's say $1,000, and cash is appearing, let's say $500. This is the position on 31st December 2021. Maybe on the 1st January, different situation is there. Maybe this cash has been paid to this bank, this loan in that case. So maybe the 1st January, their loan is only $500. We don't know that thing. This situation which is appearing, which is $1,000 as a loan and the cash of $500, it is the situation on 31st December only. Are we good? Anyone, any question up till here? Please feel free to ask if you have. No? Okay. P&L, profit and loss statement. We also call it the income statement. We also call it the statement of earnings, various names. Statement of earnings in that case. Balance sheet, we also call it the statement of position. Cash flow is called cash flow only, cash flow statements. Okay. We are going to discuss a basic format which we are going to use a lot in the entire course. Let's copy that format. Sales. From sales, first we are going to reduce COGS. What is COGS, everyone? Cost of goods sold. But what exactly the meaning of COGS? Goods on sales, cost of goods sold. But what exactly the meaning of that? Purchase, just the purchase, money spent to make that revenue. Good point, Vijay. So everyone, COGS is basically, it's the cost. It's all going to be your cost for manufacturing that, for manufacturing, everyone, not for marketing, right? I'm saying just the manufacturing expenditure. So here we are talking about all the manufacturing cost for making the product is going to be the part of the COGS, right? Manufacturing. So that means, is the marketing included in this, everyone? You are selling this product, right? Whatever the product you're making, you're selling it via Amazon and you have to pay the commission to the Amazon. Will that be included here? in the COGS? No. Here it's a pure and pure manufacturing expenses, pure manufacturing expenses. What will I get after reducing this? Correct, Parminder. It is going to be raw material, labor, and direct expenses. Correct. What will I get after this? Correct. We'll get the gross profit. From this, what should I reduce next? SG&A. We'll arrive at EBITDA. Question is, what is SG&A? SG&A. Selling, general, and administration expenses. That means anything which is non-manufacturing, right? Anything which is non-manufacturing will come here. For example, let's say you are doing the business of shoes. You are manufacturing the shoes and you have your own showroom, right? Here, this is your factory. In the factory, you manufacture the shoes. And this is a showroom. You sell your shoes here. Okay. Whatever is the rent of the shoes, everyone. Rent, what is going to be the rent? Is it SG&A or COGS? Rent of the showroom, it is SG&A or is it COGS? It SG&A, right? Absolutely. There are furniture. Obviously, the customers will come. Where will this sit, right? So there are furniture lying in this. Furniture, right? So in that case, whatever the furniture you're buying, whatever the expenditure you are incurring on that, right? Where this will go into SG&A? SG&A, fixed asset, right? And the depreciation on the same will also go into the SG&A in that case. Okay. You have hired some salesperson. Everyone, you have hired some sales people over there, and you are paying the salary to them. Where will this salary go? This is going to be SG&A. Okay. Similarly, everyone, there would be some people who are making the shoes. There would be some labor in your factory who are making the shoes, and you are paying the wages to them. Where this wages will go? This will go into COGS. It's very important to understand the difference in that case. Same salary, same, but you have to see what is that salary is for. If it is for manufacturing, it will go into COGS. If it is going for non-manufacturing, it will go to SG&A. Are we good? For example, rent of the factory, everyone, rent of the factory. Where will it go? The rent of the factory. It is going to go into COGS, right? Because COGS, why the factory is there? Factory is there because you are making it, right? You are making it. In this case, that's going. You are manufacturing anything. That's why it is going to be COGS. Are we good up till here? So this is going to be COGS, and then from which we are going to reduce the SG&A. From this, we are going to reduce the depreciation and amortization. We will arrive at EBIT. From EBIT, what should I reduce next, everyone? From EBIT, what should I reduce next? I'll reduce interest. Correct. No, depreciation we have already reduced. We'll reduce interest. We will arrive at PBT. What is PBT? Profit before tax. Profit before tax. From this, I'm going to reduce tax, and I will arrive at PAT, which is profit after taxes. Please copy this. We are going to use this extensively a lot. We'll refer it again and again. Let me know whenever you're done. Done. Shall I move? If you have copied. Please keep making the notes, would be very helpful for you later on for your revision. Okay. Everyone got the book? Is there anyone who does not have a book? Right. Everyone has a book, right? Okay. So we'll keep on reading as we are progressing in this case. Sure, Parminder, does not matter. I'll run the book for you. You can read it directly from my PDF also. When are you expected to receive, Parminder, the book? Sure. Okay. First chapter, financial statement analysis. So we are going to analyze the financial statement in that case. Now, when you analyzing the financial statement, everyone, okay, financial statement analysis, right? What are we doing here? Financial statement analysis. How do you analyze the financial statement? How do you analyze the financial statement, right? For example, many of you might be investing, right? How do you invest, right? Obviously, you see some, obviously, one way is to see some YouTube videos and invest like that. But if you actually analyze any financial statement, how do you do the analysis? What are the things you actually look for? Maybe you will look ratios, right? Profit percentage, good point. Profit percentage, year on year profits. When you say profit, everyone, what do you mean by? Do you mean by the PAT? Do you mean by the? Do you mean the EBIT or do you mean the EBITDA? What are you looking? You look for the sales. You will look for the liabilities. You will look for the growth. Good points. When you say profit, you mean PAT, right? You will look for the overheads. Are you actually telling me, or do you look so many things? Overheads. Anything else? Net income compared to. So basically, PAT percentage, correct? Net income, PAT percentage, correct? Correct. But don't you think, everyone, that uh, if you look everything absolute value, it's very complicated for you to understand. So if it is 1 year, right, it's very easy, right? If I tell you this is the data for 2021, okay, it's very easy, because here there is going to be only one sales number, there's going to be one profit number, the way you're saying the liability, everything is going to be one number. But if I tell you, if you look the data for 10 years, so that means so many figures into 10 years is going to be so complicated, right? It's so layered in that case. So in that case, we generally do few things in that case. We try to identify how do we analyze it better in that case. We see ratios, isn't it? We see the ratios. We say, okay, what is my debt equity, right? What is my PE ratio, right? What is the current ratio? What is going to be my profitability, PAT percentage, something what you're saying. So you will see the ratios in that case. I think you always see that. Second is, maybe sometimes you see the graph also, that is it going up? Is it going down? Is it stable? Is it going to be cyclical? How is the graph looking in that case? One of the such method we say is also the vertical statement, vertical income statement. What is vertical income statement? Vertical and the horizontal. Vertical is basically what happens here. If I tell you so many figures, it's difficult for you to retain in that case, versus if I convert everything in the percentage, it's much easier for you to retain in that case. What do I mean by that? For example, if this is your sales, sales is $1,000, COGS is, let's say, 700, so gross profit is going to be $300. Then the SG&A, is 150. So this has become 150 in that case. Now, so many figures is very difficult for you to retain in that case, right? And if I tell you other company, it's going to be very difficult for you to retain like that. So in this case, we will convert everything into percentage. But percentage of what? We will convert into the percentage of sales. That means here it is going to be 1000 divided by 1000. That means 100%. This is going to be 700 divided by 1000. It is going to be 70%. It is going to be 30%. It is going to be 150 divided by 1000. It's going to be 15% and eventually 15%. Is it clear, everyone? How am I going to how I'm doing it? I have just converted everything in the percentage of sales in that case, right? Simply I have converted in that case. What is the advantage of that? Like, I don't know why we're doing that. What is the advantage of that? Advantage here is going to be, everyone, you can compare the companies with a different size also with that, right? For example, if I tell you two companies, sales is given for company A and company B. $1,000 and $100,000. COGS is given $300 and this is giving $70,000. This is 700. This is 30,000. This is gross profit. SG&A is 200 and this is 500. This is going to be 15,000. This is 15,000. Which is a better company, everyone? A or B? Which is the better company? Operating profits. What do you think? Which is the better company? A, B, okay. Why A, why B? Okay, 2A. %50 profit compared to sales. Okay. How about B? Sarvana, how about B? It's 15%. Good point. Correct. So if you are looking absolute terms, right? If you are looking absolute terms, maybe you will go for the B in that case. But if you look for the percentage in that case, you will go for A in this case, right? How you're arriving at these figures? What are you doing mentally? Though verbally you're not aware of it, but mentally, what are you doing? You are just converting everything, right? How you have done this, right? You're converting everything into the percentage. Absolutely correct. So what you have done here, you have converted into the percentage. This is going to be 100%. This is 30%. This is 70%. This is 20%, and this is going to be 50%. Similarly, this is 100%, 70%. 30%, 15%, and this is going to be 15%. But if you see here, everyone, if you see here, if I don't convert into percentage, can I compare it? No, it's just not comparable. How can I compare 15,000 and 500? This company B, is almost 100 times bigger. I just can't compare it. But the moment I convert into the percentages, so easily you have told me that I'll go for A company in that case rather than the B in this case. So basically, what are we doing with this? What is the advantage of this method? The advantage of this method is going to be that it helps you in comparing the companies with a different size in that case. You can compare Reliance Industry with a smaller company like Ambika Cottons also in that case. So you can compare a different companies in that case. Is that point clear, everyone? The advantage of the vertical analysis, right? Now let's see it from the book. I am on first page of your book, which is going to be 1.3. Vertical and the horizontal analysis. Common size common size financial statement, also called the vertical analysis. This is common size is called, it is also called the vertical analysis. Show each item in the financial statement as a percentage of a base amount within the each statement. Income statement vertical analysis. How do we do? Income statement, every line item divided by net revenue multiplied by sales. That's what you have done in this case. All the line items in the income statement, all the line items in the income statement are expressed as a percentage of the net sales revenue, allowing the comparison of the operating performance between the two differently sized entities, especially those in the same industry, right? So obviously you should compare the companies within the same industry, right? I really cannot compare Tata Steel with the TCS, Tata Consultancy in that case, though same group, Tata Group in that case, but still I can't compare it because it's a very required a lot of capital expenditure is required in the Tata Steel, right? Because it is a heavy capital intensive industry. But if I talk about the TCS, it is a capital light industry. It is a consulting, right? It is into the IT consulting in that case. They don't need to buy a lot of plant and machinery in that case, but Tata Steel needs to buy a lot of plant and machinery in that case. So absolutely different companies, same group, same management, but still the stark difference in that case. Entities in the same industry generally have the similar percentages during a period. Understanding the composition of the cost enables you to identify the significant items that influence the profitability. Vertical analysis can also be used to apply the different denominator within the income statement. For example, if the general and estimations are focused, then the SG&A could be used as a denominator for all the expenses. Let's discuss this example. For example, let's say we are talking about a company which is having a sales of, let's say the same example, 1,300, 700, 1,000. It is having COGS 300, 700, and SG&A is how much? 200. Now I know SG&A is the 20% of the sales in that case. Absolutely okay. I understand that point, right? In the SG&A, there would be many items in the SG&A, right? In the SG&A, maybe you are giving the salary to the staff. Let's say $50. Maybe you are paying the showroom rent, which is $30. Let's say you are paying the commission, right? You are paying the commission to the Flipkart, which is again another $40. Freight out, correct? Let's say freight out is you are paying it, good point, which is basically the sales cost also, which is 30, 80, 120. Let's say 45, let's say. How much is left? 70. Minus 200. 35 is left. Tell me any other expenditure. Electricity, let's say. Electricity, you're paying electricity of your showroom in that case. Now, if I convert, right, if you see the total is 20%, right? But I want to know that within the SG&A, right? Within the SG&A, which is the major expenditure in that case? One is to see the value wise, but again, the value is going to be complicated. So what I'm going to do in this case, I will convert everything in a percentage of this, right? So what will I do in this case? I will say this is 200 and this is 50. So this is going to be 50 divided by 200%. So this is going to be 25%. How I am calculating the 25%, everyone? 50 divided by total in that case. This is going to be 30 divided by 200%. So 15%. This is going to be 40 divided by 200%. 20%. 45 divided by 200%. 22.5%, and this is going to be 35 divided by 200%, 17.5%. Now, if I look the overall, it's very difficult for me to gauge in that case. But when I look more narrowly, when I convert it like that, overall, it looks very high number, very lower number. And if I do percentage of the sales, the number will look very small. I will not be able to understand it. But when I convert it into the percentage of SG&A, I will get to know what is your maximum cost, everyone. If I ask you in the SG&A, what is your maximum cost? $200. correct. But in the $200, what is the item which is the maximum cost? Your salary, right? Salary you are paying, this is a big high cost. Again, the freight you are paying, it is a very high cost in that case. Commission for the Flipkart you are paying, it is a very high in this case. So by doing that, converting into the percentage of any cost, you will understand it much better, because the percentage look better, will look higher. But if I convert this in the 1000, the number will look very small in that case, and I will not be able to take a better judgment in that case. Is the point clear what we are doing, everyone? So within that category, we are going to further break it down on the basis of that, so that we can further narrow it down in that case, right? Let's see this. Let's read this again. We'll understand it better with this. Vertical analysis can also be used by applying a different denominator within the income statement account. For example, if the SG&A expenditures are the focus, then the general expenditure could be used as a denominator base for all the expenditure line items that are included in that case. The benefit of it is that it makes differences in the expense account more obvious by using a smaller base, as opposed to less obvious when using the revenue as the base, because the number is going to be look different in that case. So this is the company. We are talking about two set of the companies. One is the big city restaurant, second is a local restaurant in that case. If you see big city, number is looking very high. If you see 1 million COGS, gross profit, operating expenses. Everyone, which is a better company? Big city is a better company, local is a better company, without looking into the answer. Let's call it B, let's call it L. B is better, L is better. Okay, Shekhar says L. Everyone? L is better, B is better, local is better. Okay, why are you saying local is better, everyone? Why is that so? 15% margin, right? Big city is only 5%. Okay, so you're doing it 50,000 divided by 1 million. Absolutely correct. This is 5% margin, and this is 15% margin. Correct. Have you calculated on the gross margin, gross profit level also? What is the gross profit level? 50% here. And how about here? 75%. Wow. So definitely one is the gross profit is very different in that case, right? So that means COGS is definitely very high here, right? In the percentage terms, obviously in the percentage terms, it is very high. Second is, that means if I talk about, they are coming from here to here. Is this 75%? Okay. If I ask you, everyone, if I ask you where COGS is better, big B's COGS is better or L's COGS is better? You're right, absolutely. L should be the correct in this case, because the net income is better in that case. And let's go further deep down into that. Correct. L is better because here this is just 25%. Here it is almost 50%. Can you tell me on the operating expenses level, which is better? B is better or L is better on the operating expenses level? Correct. On that level, see, if we look on the total level, definitely you are right. PAT is good, but if you see here, it's just 45% they are doing in this case, and here they are doing 24. That means they are going almost 60%. Why it could be? Because see, it's a big company, right? They have already established. In that case, they might have created the brand. In that case, local restaurant, maybe they will doing a lot of marketing in that case, right? So since they are having a lot of gross profits, they can utilize that. How will you do the marketing, right? You will do the marketing when you are having the gross profit. When you do not have a gross profit, how can you do the marketing in that case? So maybe the local restaurant, they are saying that we are any which way is making a lot of gross profits. Let's do one thing. Let's spend more money on the marketing so the people will becoming more aware about this. So maybe they are looking to create their brand equity in that case. So absolutely correct in this case. So yes, it is 45% and it is going to be this. Eventually, this is correct in this case. So so majority of the gross profit is going here. Correct. Okay. Balance sheet, whenever we are doing the vertical. So when we discuss, it is the income statement, we do percentage of the sales revenue in that case. But when we talk about the balance sheet, we will do the percentage of total assets. How about the liability side? Same, balance is the same. So that means if I'm making the balance sheet, in this we are having plant and machinery 100. We are having furnitures and fixtures of 200. We are having cash of 150, and we are having accounts receivable 50. So total is $500. Similarly, here we are having equity share capital, let's say 100. Liabilities are, let's say 400. Again 500. So if I want to convert, I'll convert this on the basis of 500. So this is going to be 20%. This is going to be 200 divided by 500, 40%. This is going to be 150 divided by 500%, 30%, and 10% in that case. Total is going to be 100%. Similarly, here, this is going to be 20%. This is going to be 80% in that case. Total is going to be 100%. Okay. So common size balance sheet, it is also called the common size balance sheet. It is going to balance sheet items multiplied divided by the total items multiplied by 100 in that case. Okay. Now let's see. The company's management has set the targets for the specific balance sheet accounts as a percentage of the total asset. They said decided this is the target. This is not the actual. This is the target they have done. That sales should be, the cash should be 5% of the total asset. Plant and machinery, property, plant and equipment should be 50% of that, and current liability should be 10% in that case, right? This is their target. Let's see what is their actual coming. Actual is 50,000 divided by 410,000. So if you see, this is 31st December they are using. So how much is actually actual cash, everyone? If I see here, what is the actual cash you're using in this? Approximately 12%, correct. So this is target and the actual is more in this case, correct. Then we have the property, plant and equipment, which is 120. So 120 divided by 410. How much is the plant and machinery in that case? Yes, correct. This is 12%. How much is the plant and machinery actual? 29%, correct. This is 29%. How much is the current liability, everyone? This is current liability. %, 160 divided by 410. Correct, 39%. Very good. 39%. So this is going to be 39%. So what you have done here, cash you have kept more, plant and machinery you kept it less, current liability is more in this case. So what you can do one thing in this case with the cash. whatever is the excess cash you are having. With this, you can purchase the property. In this case, with this, this will go up and this will go down. That's something we wanted. We want to keep the cash lower and the plant and machinery higher. Is that point clear what I'm saying, everyone? Since the target is lesser, so what we can do with that cash, we can buy the plant and machinery in that case. Sure, Sarvana. What I'm saying is, see that this is target, this is actual. Is this point clear? Right? If you see, target of the cash was 5%, but we kept it 12%. So that means we have kept higher than the target. Is that okay? The arrow, see the arrow, is it going up? So we kept more than the target. If you see plant and machinery, we thought we'll keep it 50% of that, but we actually turns out to be only 29%. So that means you have kept it less. Is it correct? Is it okay? Okay. Current liabilities is 10% you thought, but eventually you kept more than that. So that means it is going to be higher in that case. So what we can do in that case, what is the we can do in this case? What I'm saying is, correct. So what we can also do in this case, option number 1 is this, that you will purchase plant and machinery with this cash, right? What is going to be the solution in that case? With that solution, the cash will go down and PP&E will go up. Is this point clear? Yeah, Sarvana. That's one option. Second option, what Shekhar is suggesting, is also very good option. That's the option number 1. Second option is, do one thing. You are having cash. With this cash, you pay your current liabilities. What will happen in this case? Cash will go down and current liabilities will also go down. But we need to increase the plant and machinery. In that case, what you can do with that, you can raise the equity more. You can raise the equity, and whatever the money you are receiving with the equity, in that case, you will purchase the plant and machinery. Is this point clear? Read the commentary, very basic in that case, nothing to worry about. Basic commentary, just quickly read that, then we'll move. Nothing technical in that case, so don't worry about in this. Whenever you're done. Okay, we have done vertical. Let's quickly recap what we have done. We have done vertical. Vertical is going to be, if it is going to be income statement, it is going to be percentage of the sales. If it is the balance sheet, it is going to be percentage of the asset only. Now, horizontal, we are looking in this case, see, vertical. Just imagine. What is vertical? Vertical is this. That means you are converting everything on the percentage of sales, right? So that means you are converting like this, right? That's how you're converting in that case. What is the meaning of horizontal? The meaning of horizontal is you are comparing it year on year. You're comparing year on year. So that means when you are sitting in 2022, you are comparing what is my profit in 2022, what is my profit in 2021, what is my profit in 2019, what is the difference in that case. So you're comparing year on year. We are comparing year on year how much the change has happened in that case. If I talk about the vertical, you are converting everything in the percentage of sales or the percentage of asset. Here you are converting everything on the year on year and see how the performance is going in that case. That's the horizontal. Okay, let's see it from the book. Horizontal analysis, management can use the horizontal analysis base year trend analysis. That means you will keep 1 year as a base, right? Whatever is that year you want to keep it as a base, and then you're going to change how much is going to be the change in that case, in combination with the common size in case statement to examine the changes in the accounts over the time. Horizontal analysis has focus on the account balance increase or decrease in relation to the specific base in that case. Let's see example here. Current year is this, base is there. Base could be anything. Base could be whatever you decide in that case. Let's say base is going to be 2015 in that case. After that, you're saying how much is the changes from the 2015 in that case. Let's see. These are the 3 years given to you. Again, 31st December, if you see. So this is something 3 years are given. Then we are going to compare in this case. When we are going to compare in this case, we will compare it with this. Base year is going to be obviously year 1, that is the first year. So we are going to compare this. Second, we are going to compare in this case, we are going to compare this. And how we are going to see how the performance of the company is going in that case. Again, we are not looking for the different companies. We are looking your own company on the period on period. So when I say year 3 and year 2 in that case, right? So in the year 3, it is 161. In the year 2, it is 1638 in that case. So which is better, everyone? Year 1 is better, year 3 is better. Year 3 is better. How we are arriving at 161, everyone? How arriving at 161? How to arrive at this 161.54? Go back and see that. What is the base formula for us? Base formula is going to be correct. It's going to be current year divided by the base with the $100 in that case. Correct? Easy peasy. We also calculate the growth rate. How do we calculate the growth rate? Growth rate is going to be, see, for example, everyone. For example, if the sales is 100, let's say the sales of 2020 is 100. And now it has become 2021, it has become 150. How much is the growth? If I ask you, what is the growth? In the percentage terms, how much is the growth? 50% growth? Is it? How do we arrive at this? So current year figure 150 minus $100 divided by, should I do 150? Should I do 150? No, $100. $100 multiplied by 100. Correct. So you're right. It is going to be 50%. That's one approach to doing it. I like the other approach. The approach I like, I say whatever is the new figure. What is the new figure in this case, everyone? New figure divided by old figure. What is the new figure? 150. So what I do is new figure divided by the old figure. That means 150 divided by the 100 minus 1 multiplied by 100. So this is going to be 1.5 minus 1 into 100. So this is going to be 0.5 into 100. So that means 50%. I find it much easier rather than subtracting and doing anything. I like this approach. So same result, you will get exactly the same approach, whether you follow this or you follow this old and new in that case. Is this clear, everyone? How to arrive at this annual growth rate? So it is the percentage changes giving on year basis in that case, 16.67. So that means if I calculate this. 2100 divided by 1800 minus 1. So if I do here for 16%, how do we arrive at 2100 divided by 1800 minus 1 into 100? We'll arrive at 16% and henceforth in that case. So in the, it's a very good point, Sarvana. In the growth rate, we are keeping the 1 as a base, right? 1 year we are keeping as the base, and we are just comparing in that case. Annual, if you see, it's a year on year. If you see this here we are not saying the 1 versus 2. See, here we are not doing 1 versus 2. Here we are doing year on year. From here to here and from here to here we are doing in that case. Plus we are looking how much is the growth which is happening. That's a second difference in that case. Second, we are saying how much is the growth we are increasing. We are not saying how much is actually the value which has become. We are saying how much is the growth which is happening. So we are not looking for the base year. We are looking year on year. What is the growth which is happening? Is this point clear? Okay. If you look here, everyone, let's look every item in this case. Sales. Sales is much better in this year, right? If you see the year on year growth, if I look, 38% is much better. So that means the difference in the year 1 2, it is very, very significant in that case. It is 38%, which is significant. After that, it has fallen. Again, COGS was 36% here, and it is 15% now. So that means your gross profit was significant in this case, which has gone down now. Again, the profits was very high here. It has again fallen in that case. That's the percentage change in that case. Again, the similar things we can apply the percentage annual growth on the balance sheet items also. Is that okay, everyone? Any question? No? Please read this. If you face any problem, please let me know tomorrow. We'll do a couple of questions. I'm leaving it for you to revise it once. I will further complicate it tomorrow. I'm not complicating it today itself. I'll further do few questions. Then we'll go further deep down it. Let's keep it simple today, right? So what we have done 3 things in that case. We have done the vertical. Vertical is going to be percentage of the sales, percentage of the asset in that case. Second, we discuss about the horizontal. Horizontal, we are comparing 1 year, which is the base. And then we are saying how much is going to be the change in that case. Third, we have done the annual growth. That means we are comparing from the previous period, what is the change in that case, which is going to be the new value divided by the old value minus 1 multiplied by 100. Simple 3 pointers in that case. Okay. Now let's discuss few ratios now. Let's discuss the few ratios in that case. We discussed that if we are doing the financial analysis, ratio is a very good way of understanding anything, right? For example, if I tell you that the debt equity of any company is 5:1, is it a good company or a bad company? Is it a risky company? What do you think? Is it a risky company? Yes, because the debt is very high in that case. See, that's the advantage of our ratios. I don't have to tell you the figure. I don't have to tell you that this value is $5 million. This is $1 million. I don't have to tell you number in that case. And you don't have to waste your time in doing the calculation also in that case. Straight away, I told you 5:1 and you say, no, it's very risky in that case. That's the advantage of a ratio. That's the advantage of a ratio. By looking into that, you're not wasting your, again, what are we doing in that case? We are saving our time so that we can do more quality analysis, right? That's the purpose of using the ratios, that we can have a quality analysis in that case. We are going to discuss now going forward. We are going to discuss the variety of the ratios now in this case. First, I want to discuss before I go to few categories of the ratio is the, what do you understand by working capital? What is working capital, everyone? Okay, Parminder, you can share on the group so that everyone will learn. Correct. So I'm writing day-to-day operations, current asset minus current liabilities, capital to run the business. Okay, I think very valid point and very good points also. Correct. That is something you need for running this in this case. Okay. Working capital, do you want the working capital to be high? That you should have higher working capital? Okay, two answers, no, yes. Why no, why yes? Anyone? Okay, let's do one example. We get the current liabilities also, get from current liabilities also. Correct. High working capital gives the strength to the business. So not much is required. Okay, let's understand it very simple, with no fancy jargons, with a very simple way, right? Let's say you are doing a business of a furniture, right? You are doing a business of making furniture. What do you need for making the furniture? What is the first raw material you need for making the furniture? For making furniture, what is the raw material do you need? Correct? You need wools. So let's say you go to a supplier, and ask for the wood. In that case, supplier gives you the material. Let's say on 1st January 2022. Now it's not like that you're going to, it's just not like a magic wand, you're going to touch this and it's going to be the furniture, right? You will take time, right? Your factory will run it and eventually you will take almost, let's say, 1 month. So by 31st January 2022, your furniture is ready. In that case. Now you will sell it to the customer. Now customer will say, okay, I can't pay you the money right now, I'll pay you money in some time, right? So you sold it to the customer, and customer gave you the money on 28th of February 2022. Now the supplier which gave you the wood, will this guy will keep on waiting for you that let the money come from the customer, I'll give that money, I'll take then? Will the person keep on waiting till 28th February? Yes, sometimes some people are good in that case, but most of the time maybe they will agree, maybe they not agree in that case. So in that case, let's say there is a supplier who said that I need the money right now, I need the money as you are taking the material on the 1st of January, I need the money in that case, right? What will you do in that case? Do you have the money on 1st of January? No. What will you do in that case? If the person is demanding the money on 1st of January, what will you do? You do not have the money right now on the 1st of January. You will borrow it. Good point. From where you will borrow it? Who is going to give you? Correct. You will go to a bank. And say, this guy is banging my door. I need the money right now. So can you please give this money? So bank will give the money to the supplier on 1st January 2022. And as when you're receiving money from the customer, you are going to give the money to the bank on 28th February 2022. Is bank such a nice person? Is the bank going to give you the money for free? No. Bank is going to charge the interest in that case, right? How many months interest? How many months interest? Correct. It will charge for January and February. It will charge the interest for January and February in that case. That means a 2-month interest it is going to charge in that case. That entire arrangement is called the working capital financing. WCF. That means you are arranging your working capital. You're arranging your entire working capital. You have to pay your supplier. That's why you take the fund from the banks and you have arranged in that case. Is this okay, arranged, everyone? Customer, we call it the accounts receivable, right? Furniture, whenever you are rating, we call it the inventory. In that case, that's going to be your creditors. Are we good, everyone? Okay. If we talk about working capital, everyone, there are three pillars of the working capital. There are basic three pillars of the working capital. First is going to be accounts receivable. In India, we call it debtors. Second is going to be inventory. And third is going to be accounts payable. So we call it, in India, we call it debtors. We call it stock. We call it, what do we call it, accounts payable? Creditors, right? Correct, creditors in that case. So these are the three pillars of the working capital. So we will go back and look every item one by one now in this case. Okay. Now, if I talk about working capital, everyone, as we said, we are having three things in that case: debtors, inventory, and creditors. What do you want, everyone? Do you want to receive money from the debtors fast or slow? How do you want to do it? I mean, do you want to receive money from the debtors fast or slow? Or you're saying it's okay, give me the money whenever you need money, whenever you have it? No, you need fast, you need very fast. Correct. Creditors, do you want to pay the creditors fast or slow? Correct. As slow as possible, as late as possible, right? You don't want to pay the fast in that case. If the creditors, as far as the creditors is not charging an penalty, we are more than happy to pay it as late as possible. Absolutely. Inventory, everyone. Do you want your inventory to be converted sooner or later? That means it should get finished. In this case, inventory, you want it to be soon. So that means conversion of the inventory, you again want it to very soon. You want it fast in that case. Correct. Is this clear? I think I have not told you anything. Is something you have done it. Correct. We'll do one item one by one. Let's first do the debtors. For doing the debtors, we will do the first ratio of R, which is called the debtors turnover ratio, DTR. Debtors turnover ratio, DTR. Anyone is aware what is the formula of it? What is the formula of DTR? It's okay if you don't know. It's okay, absolutely okay. DTR is going to be credit sales divided by average debtors. Credit sales divided by average debtors. Let's do few things in that case, everyone. Should I use credit sales or should I use the total sales? What do you think? Credit sales, correct. Because when you are making the credit sale, only then you will have a debtors. Otherwise, if someone you are selling in cash, you don't have a debtors. So total sales is not a correct measure to it. You should do the credit sales. Hopefully numerator is clear. Now the denominator, should we not see as the closing debtors? No, we don't do that. Reason being, everyone, numerator, what is the numerator? Credit sales. Credit sales, we are looking for the full year. Right? Sale is not like that you are doing 1 year. You sale, you will keep on doing the full year. This full year. But if I take the closing debtors, everyone, We discussed debtors is the balance sheet item. Balance sheet item, that means 1 day position. Do you think it is correct if I take the closing debtors? No. Numerator, you are taking full year. Numerator, you are taking full year. Denominator, if you take at one point of time, it would not be correct. That's why we take the average. We take whatever is the opening, whatever is the closing, we will average it out. Now, this is also for the full year. Numerator, denominator is also average. Now it's a parity. Now it's a parity. That's why we do the average. Is this point clear, everyone? So here, sure, in this case, no problem, Shekhar. So Shekhar, what I'm saying is sales, right? If you see here, sales is for the full year. Am I correct? Sales, whatever you do the sales for the full year. Is it correct? So your numerator is for the full year. But if I take the closing debtors, right? That means if I take the debtors as on the date, right? It would be not be correct. Numerator, you are taking it for the full year. Denominator, you are taking at the end of the period. That would be incorrect. That's why we take the opening. That means the debtors of the previous year plus the debtors of the closing, and we average it out. Now this is average position. This is for the full year. So it's a parity. Numerator is the full year. Denominator, it's the average. Now they are into the parity. Is this okay? That's why the formula is this. Credit sales divided by the average debtors, not the closing debtors. Is this okay? Everyone up till here, is that okay? Okay. So this is debtors turnover ratio, right? Related to that ratio, related to the debtors turnover ratio, there is one ratio which is the number of days. Number of days is how many days in a period? 365. In a full year, 365 days in that case, divided by debtors turnover ratio. What does this number of days shows? Number of debtors days. What does the meaning of that? It means how soon you are receiving your money, how frequently you are receiving your money in this case. So you want this number of days to be high or low? Everyone, do you want this number of days to be high or low? Number of debtors days mean that how frequently you are getting your money, how soon you are receiving your money. That means, Parminder, what I'm saying is there are two people. There are two customers, customer A and customer B. Customer A is giving you the money in 40 days. Customer B is giving you the money in 300 days. Which is a better customer? Customer A. That means the person who is giving you soon. That means the number you are looking is lower. Am I correct? That means lower number we are looking in that case. That means whoever is giving the money sooner in that case. That's the meaning of the number of days in that case. Smaller in this case. I want the smaller number in that case. Is that point clear, everyone? Number of days should be smaller in that case. Okay. If this is something you want smaller, everyone, if this is something you want smaller, debtors turnover ratio, do you want it to be higher or lower? Debtors turnover ratio, do you want it to be higher or lower? High. I got one low. Okay, let's quickly do one thing. Okay, ignore this. If we calculate any ratio, okay, if we calculate any ratio, ratio is the culmination of numerator and denominator. If the numerator is higher, ratio is going to be high or low? If the numerator is higher, ratio is going to be higher or low? Quickly. It's very easy. Think and answer. Numerator is higher, ratio is going to be high, everyone. What do you say? Yes, it is going to be higher. No, it's not going to be. Yes, it is going to be. For example, if I tell you debt equity, yeah, okay, fine. So this is going to be high in that case. Okay. If I denominator, okay, if I increase the denominator, everyone, the ratio is going to go up or down. The ratio is going down. Is it correct? Everyone be involved. You will not understand this otherwise. Correct? It will go, if the denominator is up, if the denominator is higher, the ratio will go up or down. It will go up, Shikhar. Okay, let's see this. Okay, let's quickly see that. This is, we are calculating debt equity. Debt equity is, this is 100, this is 50. What is the debt equity will come? What is the ratio will come? 2. Debt equity will come 2. Correct. 2 raised to come, or I can simply say 2. If I'm increasing the equity, let's say I make it 100 and this is also 100. So that means it has gone up. What is going to be the debt equity coming now? Shekhar, what is going to be the debt equity? 1. Correct. So that means denominator you are increasing, ratio is going up or down? Ratio is going down. So that means here, when you are increasing the denominator, ratio will go up or down? Ratio will go down. Okay. Now, if we reducing the denominator, what will happen with the ratio? If we reduce the denominator, it is going to go up. Correct. And lastly, let's say we are actually reducing the numerator, everyone, then reducing the numerator, what will happen with the ratio? The ratio will go down. Correct. Hopefully it is okay. Now go back and see this. In this case, we discussed what do you want from the number of days. In the number of days, you want it to be lower. In the number of days, you're saying lower is better because I want my money really fast in that case. So if you want this to be lower, debtors turnover ratio, it is into the denominator. What do you want? Do you want it to be high or low? What do you want, everyone? Debtors turnover, do you want it to be low or high? So Shekhar, if you want it to be low, right? If this becomes low, number of days will become higher or lower? If the debtors turnover becomes lower, number of days will become higher or lower? Number of days will become higher, right? But do you want that? No, no, no. If the denominator is down, right, the number of days will go higher in that case, and that's something we don't want in that case. That's why debtors turnover ratio higher the better. Debtors turnover ratio higher the better. Is this point clear, everyone? Correct. Okay. What is the meaning of debtors turnover ratio? Please understand the meaning of debtors turnover ratio. Turnover ratio, right? So if it is the full year, if this is the full year I'm talking about, the meaning of the debtors turnover ratio is how many times you're churning your debtors in that case. That means You sold the material here, the money is received here. You sold here, money received here. Sold here, money received here. You sold here, money received here. Sold here, money received here. So that means how many times it is churning? How many times these circles? The circles, how many times is coming in that case? That's the meaning of churning in that case. What do you want, everyone? Do you want these circles to be more or less? Do you want these circles to be high or low? Correct. You want it to be more, right? That's why you want it to be more in that case. That's why the debtors turnover ratio is higher in that case. That means you wanted more churning and faster in this case. You want that person will come and immediately give you money next day in that case, so that I will sell it more and more in this case. Okay, let's do few questions in that case. I think that will understand much better with this. We have done this. Let's try a few questions on this. Let's say everyone, let's say that credit sales is $100,000 and average debtors is $10,000. Can you please tell me the number of days? Everyone try. Try. No, do with formula. No, do with formula. 100 looks wrong. No, you're telling me the DTR. I'm not asking for the DTR. I'm looking for the number of days. Shall I show you the formula if you have not noted? That's debtor turnover ratio, and that is going to be number of days. Try everyone. Correct. Debtors turnover ratio is going to be 100,000 divided by $10,000, which is going to be 10. This is going to be 365 divided by 10, so 36.5 days in that case. Correct. This is days. Anyone, any question here, please ask. Are we good? Should I repeat anything? No? Okay. I was giving the reference on these circles. Can you tell me in this scenario, how many circles are going to be here? How many circles are going to be this in example? Correct. Excellent. 10 circles. That means you're churning it 10 times. That means you're churning it 10 times in that case. And everyone, the length of every circle, in this case is going to be 36.5. That's the basic meaning of that. That means circles are going to be 10 and the length of every circle is going to be 36.5. If you multiply this, that means the number of circles, which is 10, multiplied by the length. Please do that. What is the value will become? 365. That means this is the entire period we are talking about this. Is this point clear, everyone? That means you can turn around your sales 10 times. That means sale receiving money, sales receiving money in this case. And the period which is January is going to be 36.5 days in that case. Okay. Okay, let's quickly try one more questions and then we'll be done, I guess. Total sales is $1,000. Cash sales is $200. Debtors are giving opening debtors, closing debtors. Opening is going to be $20. Closing is going to be $50. What is going to be number of days, everyone? Number of debtors days. Please try. It's 20. Everyone, figures are 1,000, cash sales is 200, opening debtors is 20, closing debtors are 50. Number of days, I got 3 answers. 5.81. So Shekhar, you are telling me number of days, right? Sarvana is telling me 5.97, 15.97. Try everyone, very easy question. Okay, let me do. Correct, Sarvana, your answer looks correct. You can share on the group also. Everyone, first of all, we'll calculate how much is the credit sales. Credit sales is going to be $800. Simple. Now we are going to calculate what is your average. Average is going to be 20 plus 50 divided by 2, which is 35. Easy one. Now, in this case, average is given. So it is going to be $800 divided by 35 in this case. How much is going to be the debtors turnover ratio? It's going to be 800 divided by 35. It's going to be 22.86 or 85. 22.85. Number of days is going to be 365 divided by 22.85, whatever that comes in, 15.97 days. Are we good, everyone? What is the challenge you found in this question? Were the figures not clear? Shekhar, is that okay now? Arvinder, Shekhar, everyone? Please let me know if you face any problem, if it is not clear. Till the time you don't ask me, I will not get to know whether if it is not clear or anything. Shall I repeat anything? No? All good? Which portion, Shekhar? Which point? As in, can you tell me which one should I? Number of days? In this question or generally? In this question, first of all, you calculate the DTR, right? DTR, have you understood how to calculate the DTR in this? First, you get how much is the credit sales. So total sales minus the cash sales obviously is going to be the credit sales, correct? Average is going to be 20 divided by 70 divided by 2. So 70 divided by 2 is going to be 35. So we got the credit sales, we got the average debtors. We will simply divide this. That will give you 22.85, which is the accounts receivable turnover ratio or debtors turnover ratio. Is that okay up till here, Shekhar? From this, we simply divide this. Number of days is 365 divided by the DTR, which is going to be 19.97 in that case. Simple. Please note it down, everyone. The formulas, note it down, else you will not understand this. You have to retain it. You have to note it down. Shall I move? Okay. So out of all the three what we discussed, we have finished the debtors. Now let's quickly move to the inventory. Inventory, everyone. Do you value inventory, everyone? If I say inventory, sales divided by average inventory. Do you value your inventory on the selling price? Do you value your inventory on the sales? That means in your factory, some furniture is lying, right? Some furniture is lying in your factory in this case. And if I ask you, what is basically the cost of it? You will tell me the selling price. No, you will not telling me the selling price. You will tell me whatever is the cost for it, right? Basically, you will tell me whatever is the COGS for that. Isn't it? Whatever is the cost in that case. So that's why whenever we are calculating the inventory turnover ratio, that is ITR. ITR is not the income tax return. It's the inventory turnover ratio. This is going to be COGS divided by average inventory. Average inventory, same logic here, everyone, because COGS is for the full year. COGS, if I talk about, this is for the full year. So since it is for the full year, that's why we take the inventory as the average. That will give you ITR in that case. Okay. Everyone, how to calculate the COGS? Do we know how to calculate COGS? How do we calculate COGS, cost of goods sold? Okay. Cost, production cost plus all the direct cost. Correct. Okay. Does COGS come into the PNL? Does it come into PNL? Do we show PNL? We show this? Okay, we show, we don't say. Okay, in the trading PNL, same thing. We show this. So in the trading, do we show Shekhar? In the trading account, do we show that trading? Okay, let's make it the trading and the PNL. We don't show it anywhere. Okay, let's see this. What should I start with? Opening stock, am I correct? Then what should I write? Trading account, let's say. Trading slash PNL. Purchases, am I correct? Then the direct expenses. Here I will write the sales. Here I will write the closing stock. Here I will write the gross profit. Where is the COGS coming? Or direct expenses, I can say manufacturing expenses. Where is it coming, everyone? So you are saying it does not come separately. You are giving it the name, right? Am I correct? So basically, if I add all of it and if I reduce this, you are saying this is called COGS. Am I correct? So in the PNL, you will not find a separate line item called the COGS. In that case, these things, if I club them, they are called COGS. Absolutely correct in this case. So what is COGS, everyone? COGS is going to be opening stock plus purchases plus manufacturing expenses minus the closing stock. Absolutely correct. Is there any formula, other formula in that case? So all of it is cancelled. This is cancelled, this is cancelled, this is cancelled, this is cancelled. Or can I not do that? These two items are left. Sales minus gross profit. This is also the closing stock. This is also, sorry, the COGS. That's the second formula for us. Is it okay, everyone? Any doubt, please ask. Clear? Let's quickly try one question here. Sure, Sarvana, do you have any question? Not clear? If difference in opening stock and closing stock. Difference is going to be there. That's why we are reducing it. Let's try one question. Maybe you'll understand better with this. Let's see. In this case, this is the PNL I'm making. Opening stock is 100. Purchases, I'm doing it 400. Manufacturing expenses is 500, 150. Closing stock is 6. No, let's make it 50. 50 in that case. Sales is 1000. How much is gross profit, everyone? 400, right? Can you please tell me what is the COGS in this case? See the formula again, Sarvana. See the formula again, Sarvana. You're not following the formula, that's why. Minus. You can do that way also, correct? Okay, don't go for the shortcut. Do the full one first. So Sarvana, this is going to be 100 plus this 500, 650. Am I correct? Minus this. What is the total? As everyone is saying, $600. This is approach number one. $600. This is approach number one. Second approach could be this also, as everyone is saying also, 1000 minus 400, which is again going to be 600. Is this okay? So either approach, either this or that, depending on what information is available to you in this case. Okay. Anyone, any questions? Shall I move? No. Let's go back and see what we were discussing. We were talking about the inventory turnover ratio. Turnover ratio, which is COGS divided by average inventory. Okay. Okay, let's quickly try one question here. For example, let's move to the next one. Sales is given $1,000. Gross profit is $200. It is all credit sales. Okay. Okay, let's see credit sales. Debtors opening closing is 100, 200. Inventory opening closing is 50 and 90. You have to tell me two things. Number one, what is going to be DTR? Number two, what is going to be ITR? You know this, just think and answer. You will do it. Process it slowly and you'll do it. Okay, keep telling me also what is what. Okay, I got many answers. Just a second. So I got ITR. ITR is 11.42. ITR. DTR is 6.67. Shikhar, your DTR is coming 20. Why so much of variation, everyone? Credit sales is 1000. It's simple 1000. So if I calculate the debtors turnover ratio, which is 1000 divided by average is going to be 300, 150. So it is going to be 150. 1000 divided by 150, it is going to be 6.67. That is correct. 6.67 debtors turnover ratio is correct. ITR is going to be COGS. Since the COGS is not given, we have to reduce this. So this is $800 and this is average. Average is going to be 50 plus 90, 140. 140 divided by 2, it's going to be $70. So 800 divided by 70. Am I correct? 800 divided by 70. It's going to be 11.43. Is it clear, everyone? Shekhar, is that okay? Anyone, any doubt? No? Okay. We'll finish this and then we'll quickly take a break also. So don't worry about this. If you're becoming a little sleepy, we'll finish this and then we'll take a break. Inventory turnover ratio, as we said, everyone, which is going to be COGS divided by average inventory in that case. If we are calculating number of days, right? If we are calculating in how many number of days, what, if you remember, I asked you initially that inventory, do you want the inventory to be converted fast or slow? You said fast in that case. So my question again to you, if I'm talking about the number of inventory days, everyone, do you want it to be high or low? That means, do you want the inventory to be, you want to keep longer inventory or lesser inventory? Do you want to keep it the inventory for many days or lesser number of days you want to keep it? Less days, correct? You want to keep it for the less days so that you want immediate sale in that case. You want immediately it should be sold in that case. So that means number of days has to be lower in that case. So that means what is going to be the formula for the number of days? It is going to be 365 divided by ITR, inventory turnover ratio. $1 million question is, ITR higher the good or lower the good? What do you think? Inventory turnover ratio, higher the good, lower the good? I'm talking about inventory turnover ratio. Is it higher the good, lower the good? Low is going to be good. So everyone, if this is lower, if I say this is good, this is lower is good, number of days will go high or low? If let's say inventory turnover is lower, the number of days will higher or will go high or low? If inventory, this will go high. Is it good for you? High is good. Is high good for you? No, high is not good. That's why inventory turnover ratio alike. That's why inventory turnover ratio alike debtors turnover ratio is higher the better. Same logic is for that also. That means during the year, during the year, how many times you are churning the inventory. You make it, you sell it, you make it, you sell it, you make it, you sell it. So you, as we discussed, you wanted more circles. You wanted more circles. Similarly, here also, you wanted more circles in that case. For example, in the previous question, your answer was 11.43. That means you will make these circles 11.43. You will make such circles 11.343. And if I tell you number of days is going to be whatever is the gap in that. Whatever is going to be the gap in that case, that will be your number of days. Is that point clear, everyone? No? Okay, let's try one question. We'll understand maybe better with it. Simple question. COGS is given $1,000. Average inventory is given to you. That's it, $200. Can you please tell me what is going to be the number of days? Number of inventory days. What is the ITR coming for you? ITR is 5 times, not days. ITR is going to be 5 times. So yes, ITR is going to be 1000 divided by 200. So it is going to be 5 times. That means what is the meaning of 5 times, everyone? The meaning is 5 circles. 1, 2, 3, 4, 5 circles. That's the meaning of that. 365, number of days is going to be 365 divided by 5, which is 73 days. Absolutely. So that means each circle, what is going to be the duration of each circle, everyone? 73 days, right? 73 days. That's the basic meaning of that. And 5 circles. As we said, we want more circles. That means that inventory turnover ratio is going to be higher. Number of days, we are going to ask for the lower in that case. Let's quickly pack. We have done 2 things in that case. We discussed about turnover ratio, debtors, inventory. Turnover ratio, debtors turnover ratio, do you want it to be high or low, everyone? Debtors turnover ratio, you want it to be higher or lower? You want it to be high. You want those circles to be high, Shekhar. You want the circles. You want to sell it fast, receive money fast. Sell fast, receive money fast in that case. But if I tell you the number of days, but if I talk about from the number of days, it is going to be lower the better. That means how soon I'm receiving my money. You learn anyone, right? If number of days, if you can remember, do number of days, right? And then the reverse is going to be turnover ratio. Very simple approach. I think number of days is much easier for you to remember that how sooner I'm receiving my money, how much lower inventory I have to keep. So remember the number of days. The turnover ratio is going to be the reverse of that. For example, if I talk about the inventory, everyone, as you said, you want to keep the low number of days. You don't want to keep the inventory for many days. You want to keep it for lesser number of days. So this is going to be lower. So that means turnover ratio is going to be higher in that case. Is that okay, everyone? Is it clear? Okay. When I add these, everyone, if let's say this is 30 days, this is coming 30 days, and this is coming 70 days. What is the total coming? What is the total? Total is 100 days. 100 days. 100 days is called, sure, Sarvana, we'll take a break after that. 100 days 100 days is called the operating cycle. 100 days are called the operating cycle in that case. Okay, this plus this operating cycle is called the operating cycle in that case. Is this high? Do you think 100 days are high or low? 100 days? 100 days, are they high or low? Are they high? How we are deciding high and low? So, Parminder, in this case, we add this because this is my operating cycle. That means the moment I have the material in my hand, from the moment I have the raw material in my hand, from that point to making the final product and receiving the money from the customer, this is that window. This is my operating cycle. This much time I take in that case. That means from this I take that much time. Do you remember the raw material you got in the furniture example? In the furniture example, I don't know where is the furniture example. There you go, furniture example. Here, the moment you receive the material, till the time you are actually making it final and you are receiving the money from the customer. This is that cycle. That means how much time it takes to you, Parminder, to finally finish the product and get the money from the customer in that case. This is the meaning of operating cycle in that case. Is that okay? The meaning of that? Okay, we want this to be high or low. We want this to be very low in that case. That means we want very fast. We want to finish our inventory really fast. We want to get the money very fast in that case. That means we want the operating cycle as low as possible, in that case, right? Because sooner the money better for us in this case. Okay. Okay, let's stop it here only for some time and then we'll start. I know it sounds little. Let's catch up at 55. Let's take 20 minutes break. Is that okay? We'll start from there. Have your dinner if you want to have it. All right. Thank you. I'll see you then. Everyone, can you see that? Shall I zoom it more? What should be the answer? A, B, C, D. Zoom more. Uh, what should be the answer? A, B, C, D. When preparing the common size statement on the balance sheet, what do you show as a percentage of balance sheet? You show it total asset, right? And the items on the income statement as a percentage of net sales. So what should be the answer? Asset and the net sales. It should be D. Correct. What should be the answer here? A, B, C, D. D for this answer. Horizontal common size statement can be made only for the companies with at least 10 years of operational data. Have you read it somewhere that you have to have a 10 years of operational data? Okay, everyone, I'll wait for more answers. Quickly try. Correct. C should be common size statement can be used to compare the companies of the different sizes. Yes. We discussed this example. If you remember, we have done the company with 100,000 and 1,000 also. We can compare because of that. Is that okay, Parvinder? Parvinder, is that okay? About this? A useful analysis to compare the large accounting firm's operating result with a small local accounting firm is going to be, you are saying it is going to be vertical analysis. Correct. Okay, I got A, I got C. Is C correct? The same base is going to be used across all the financial statement. So that means, are you going to use the net sales in cash flow also, balance sheet also? Is it correct, Shekhar? Or maybe the asset you are using in the balance sheet also, cash flow also, income statement also? Because it says the same base is going to be used across all the financial statement. Correct, not correct. That's why C should not be the answer. Then what should be the answer? For one statement, you are going to use that, but not for all the statement. A base amount is required. I got the answer from Vijay. Correct. A base amount is required. Only then you're going to calculate in that case. Is screen not visible, everyone? Are you not able to see the questions? Sarvana? Okay. Sarvana, you can't see the questions? Okay. Try this now. You have to tell me which statement is correct. One, second, first, second, third. These are the answers. See the statement first. Which statement is correct? First, second, third. You can any which ways. I'm leaving the question above so that everyone can read the question. What do you think out of first, second, third, which statement is correct? First, second, and third, which statement is correct? All three are correct, Sarvana. Okay, Shekhar, what do you think? Shekhar says first and second, third is correct, second is wrong. Okay. Anyone else? First and second is correct. Okay. First and third, we don't have the option. Shekhar. So Shekhar saying all now. Okay. Horizontal analysis includes the comparison of the multiple line items on the income statement over a period of time. Is it correct? Okay. Horizontal analysis can be performed on any item of the income statement, balance sheet, and the statement of the cash flow. Is it a correct statement? Second is correct. Yes, it is also correct. Horizontal analysis is a method of financial statement analysis that shows each item of the statement as a percentage of a base figure within the statement. Is third correct? Is third correct? Is it within the statement you do the base percentage? Is base figure in this? So you are saying all the three. Okay. Why is this wrong? You have another choice. This is not correct. Why this is wrong? See third. Everyone, do you think third is correct? Horizontal analysis is a method of the financial statement analysis that shows each item on the statement as a percentage of a base figure within the statement. No, horizontal is making the base of the previous in that case. So it should be second, first, and second in this case. That means B should be the answer. Is it clear, everyone? Okay. So let's move. Forget about the options. Just tell me 1, 2, 3, 4, which is correct. What other statements you're finding it correct? Everyone, what should be the answer? First, second, third, fourth. What is correct? All are correct. Horizontal analysis is used to review the financial statement over the multiple period. Is it correct statement? First statement is correct. Okay. Horizontal analysis is usually depicted as a percentage growth over the same line item. Is it correct? Second is correct. Yes, this is also correct. Okay. Third statement. Third statement is correct. Horizontal analysis allows the financial statement users to easily spot the trend. Correct. Fourth, is it correct? Horizontal analysis can be manipulated to make the current period look better if the historical periods have the poor performance. Correct. So that should be. So this is correct. So in this case, Shikhar, right? If you want your current year, let's say, if you want 2020 to look better, what you will do rather than comparing it with the 2021, you will try to compare it with, let's say, 2020. Why so? Because this is a COVID year. Obviously, the performance of this year is going to be really bad. So because you want to compare it with 2020, so that this year will look very nice in that case. So you can manipulate this thing in this case also. You will compare with any year which is the bad year, so that this year will look good. Is it okay? That's what they are saying also in this case. Horizontal can be manipulated to make. No, this is manipulation. That means analysis is not correct in this case. This is manipulation only. Horizontal analysis can be manipulated to make the current period look better if the specific historical periods of the poor performance are chosen as a comparison. So rather than keeping the latest year, you are keeping the comparison point as 2020. Okay. What should be answer here? Okay, I got B. Everyone, please try. I'll wait for your answer. Okay, I got B, I got A and D in this case. In assessing the financial prospect of a firm, The financial analyst use the various techniques. An example of the vertical common size is, you're saying A, assessment of the relative stability of the, okay, Savannah. So here an assessment of the relative stability of the firm's level of the integration. No, it's not. This is not the example of a vertical in that case. I got another answer is B. A comparison in the financial ratio. A comparison in the financial ratio between two firms in the same industry. No, vertical statement is not the analysis of the ratio. It's not the ratio analysis. It is something you are comparing it, the financials percentages in that case, not the ratio we are doing it. That's why B is not the answer. Advertisement expenses is 2% of the sale. Yes, that's what the vertical analysis is. That's what the vertical analysis. That means you are doing anything which is percentage of sales. So it should be the answer. Correct. Is this okay? Parvinda, is that okay? Parvinda, is that okay? Let's do 2, 3 more. Okay, I got A for this. Okay, a financial analyst decided to perform a horizontal analysis on the statement of retained earnings. In the statement of retained earnings, what are the things which come? Statement of the retained earnings, what does it come? Income, expenses? No. In the statement of the retained earnings, so we are going to talk about the equity also later in this case, but in the statement of the retained earnings, so from the PAT, whatever is the equity that will come, whatever is the PAT that will come, retained earnings will come. So all of these items are going to come in this case, equity, PAT, retained earnings, all of it is going to come. No expenses will come here because expenses come into the P&L, profit and loss statement. That would not come here. So if you see here, a financial analyst decided to perform the horizontal analysis on a statement of the retained earnings. This type of the analysis would not show as a percentage change in, it should be expensive because expense is not the part of the statement of the retained earnings. Is it okay? Because it is a part of the P&L. Last two questions. Hmm. 20%. So following is the illustration. What percentage would the net income on a common size? Net income is 120,000, 600,000. It should be 20%. Correct. I think it's the same question, isn't it? Looks the same question. What percentage of the net income would be the financial statement? Same, should be 20%. Correct. Okay, let's move. Okay. Do we have any questions up till here? No. So what we discussed here, if it is the debtors days or if it is the inventory days, right? If we add both, we will get, what do we get if we add debtors days and the inventory days? We'll get operating cycle, OC. Operating cycle, do you want it to be high or do you want it to be lower? Operating cycle. Do you want it to be high or do you want it to be low? Low. Operating cycle, we want it to be low in that case. Correct. No, we want it to be low. So Sarvana, what is the total in that case? That is debtors days. We want the debtors day to be lower. Inventory days, we want inventory days to be lower. So obviously when we are adding both of them, the whatever is the total coming, we want that total to be low also in that case, right? Basic point in that case. Now the third category in that case, what is the third category in this, everyone? What should be the third category in this case? It's the creditors turnover ratio. We have done debtors, we have done inventory. Now the time for us to do the creditors in that case. Creditors, should we calculate the creditors turnover ratio on the sales? Creditors turnover ratio, should I do the sales by the average inventory? Average creditors, sorry. No, that would be incorrect because they should not be. What should I the value I should take? Purchase. Brilliant. Should I take the total purchase or the credit purchase? Should I take the credit purchase? Correct. I should take the credit purchase in that case. Credit purchase in that case, right? Number of creditors days, everyone, number of creditors days. Now, number of creditors days means how long you are paying the payment in that case. Do you want it to be high or low? How late you are making the payment? Do you want it to be high or low? Correct. You want it to be high in that case. You want it to be high in that case. How do we calculate this? 365 divided by creditors turnover ratio in that case. Simple. You want it to be high in that case. My question is, creditors turnover ratio, do you want it to be high or low? Creditors turnover ratio, do you want it to be high or low? Correct. Creditors turnover ratio is going to be low. Everyone, is that okay? So the creditors turnover is going to be low in that case. Okay. So what we have done up till now, let's quickly revise what we have done. We discussed the three things in that case. What we discussed? Debtors, inventory, creditors. Turnover ratio. Second is the number of days. I think the number of days, it's easier for you to retain. So let's do the number of days. Debtors number of days. Do you want it to be high or low? Debtors number of days, everyone, you want it to be high or low? Number of debtors days, high or low? Less, low in that case. Inventory number of days, high or low? Low again, correct. Creditors number of days, high or low? Creditors number of days, high or low? That means in how many days you want to pay it? You want it to be high in that case. Correct. Here it is going to be reversed. This is higher. This is higher. Who is better? You can copy this, everyone. Okay. If I add debtors days and inventory days, let's say this is coming 30 days, this is coming 40 days. This plus this, what do we call this? What do we call this? This plus this. That means 70 days. What do we call 70 days? Operating cycle, right? OC, operating cycle in this case, right? From this, we will reduce the creditors days. From this, we are going to reduce the creditors days. Let's say this is coming 10 days. 10 days. So this is becoming 60 days. 60 days is going to be called as cash conversion cycle. Cash conversion cycle in that case. Is this point clear, everyone? Cash conversion cycle, we can also call it the C3. Question. Cash conversion cycle, which is debtors days plus the inventory days minus the creditors days, whatever that comes in. Do you want it to be higher or lower? Creditors, this C3, do you want it to be high or low? Cash conversion. Cash conversion, do you want cash conversion cycle? You want it to be high or low? Lower is going to be better in this case, right? Lower is going to be better in this case, right? Because you're converting it, right? It's like your business. Do you want that since I start my inventory in that case and the money will come very late for me? No, I want money to come very fast for me. The moment I make anything and the money churning should come very fast in that case. That's why cash conversion cycle, you want it to be lower in that case. See, think how we are making the cash conversion cycle, everyone. Parvinder, how we are making the cash conversion cycle. See that. Debtors, higher the better, lower the better. Focus on the debtors. Higher the better, lower the better. Debtors stays. High is better, lower is better. Debtors days. Lower is better. Correct. Inventory, higher is better, lower the better. Inventory days, lower is the better. Creditors days, higher better, lower better. Creditors days, higher is better. Absolutely. So something which you are adding, something you are adding is lower the better. Something you are reducing is higher the better. So obviously this number is going to be lower the better. Are we good with this? Is it clear, Parvinder? So obviously something which you are reducing is higher. That means obviously the lower number is going to be better in that case. Okay. Let's say everyone, inventory days are coming 30 days. Debtor days are 40 days. Creditors days are 60 days. What is going to be the cash? What is going to be OC and what is going to be C3? Everyone, are you getting the same? Correct. This plus this, 70 days is going to be OC. 70 days is going to be OC. And when you reduce this, 10 days is going to be OC in that case. Question to you, everyone. Is it possible that C3 is negative? Okay, first of all, forget about the negative. Let's say it is negative. Hypothetically assume that it is negative. Is it good or bad? Is it good or bad? If the C3 is coming negative, is it good or bad? Question is, if C3 is negative, is it good or bad? It's a bad. Good maybe. Okay, why good? Why bad? Why do you think good? Maybe Parminder. Why do you think Shekhar it is going to be bad? Everyone, give your opinion. Why do you think it is good? What is bad? You're saying since it is negative, that's why it is bad. If we are not getting credit, it is going to be bad. Okay. Why do you think, Parminder, it is going to be good? No, it is going to be not even good. It is going to be wonderful. It's not bad. It's an amazing thing, right? It's an amazing thing. That means, what does that mean? It means your entire debtor and the entire inventory is actually funded by your creditors in that case. So in this case, negative C3 is going to be a great thing in that case. Let's understand this with the example, that whether it is possible or not. First of all, let's understand whether it is possible or not. Okay, let's see. Let's see, you have placed the order with Amazon. What do you want to order from Amazon? Quickly, what do you want to order from Amazon? Anything. I'm not going to give to you, just that laptop you're buying it. Okay, wonderful. Let's say you place the order with Amazon and you place the order for the laptop in that case. Okay. Amazon has placed the order with its supplier. So let's say you place the order on 1st January 2022. Supplier has delivered the laptop in your house on 8th January 2022. And you have, let's assume you have given the COD. That means you have paid that. obviously the Amazon has supplied this. Amazon has supplied this on 8th of January, and you have paid at that point of time. COD. Let's assume you have paid on the COD basis in that case. But it won't be the scenario that the Amazon is going to pay the supplier on that day only. Generally, all the e-commerce website, they pay it month end. So the Amazon is going to pay its supplier on 31st January 2022. Okay, everyone. Think from the perspective of Amazon. Okay. For the Amazon, who are you? Debtor or creditor? For Amazon, who are you? Debtor or creditor? You are a debtor, correct? How many days is the credit they have given to you? How many days? So you are giving the payment in 7 days, 7 days, isn't it? 8 days. Okay, let's say 8 days. Okay. So operating cycle in this case is going to be how much operating cycle is going to be, Shekhar, in this case? There is no inventory. So 8 days. Am I correct? Now, who's supplier, debtor or creditor? Supplier is debtor or creditor? Creditor. How many days, after how many days are you paying the creditor? 31 days. After 31 days you are paying in. Okay, let's say after you're saying from there, let's say 22 days, take from that base. Ideally it is 31 days from the date of the order placing. 31 days in that case. So I'll reduce 31 days in that case. What is the balance coming? 31 minus 8. 23 days. Positive, negative? Negative. Negative 23 days. Is it good for Amazon, bad for Amazon? If you talk about Amazon, is it good for Amazon, bad for Amazon? It's amazing for Amazon, right? They got their money in 8 days. And they are paying the supplier so late in that case. So that is negative is going to be wonderful in that case. That means you're getting the money much better in that case. If you see here, guys, this is the very rare situation I told you. In fact, if you see, I took the COD in this case. Let's say vice versa. Whenever you place the order, right? Whenever you place the order, in that case, you paid via credit card. In this case, the debtor's days is also 0. You paid via credit cards. Now the debtor's days is also 0. That means you have paid on the day 0. On the day 0, you have paid the amount. So it is 0 minus 31. Now you are getting the delivery here, but the Amazon got the money on the day 0 in that case. So entire 31 days is going to be negative, which is the cash conversion cycle. So this is of such a wonderful, it's a negative working capital cycle, which is working amazing for the companies. Is it clear, everyone? Why is it good? Shekhar, is that clear? That why negative is good? Okay, wonderful. Let's move. Let's see the book. Now I think we can read everything. I am on page number 38, rather 39. Please read this. Page number 39. Sure, Shekhar, you can read it from my PDF. Don't worry. I'll just tell for everyone who has the book. Page number 39, everyone. Page number 39 to 43. Please read quickly and confirm me. Shekhar, you can read from my PDF. And whenever you're done and whenever I need to scroll, please tell me. 39 to 43, everyone. Shekhar, let me know whenever I need to scroll. question is not given here, so you can see directly the wordings. Please let me know whenever you're done. Done. The rest is everything same, everyone. Cash cycle, operating cycle, everything is word by word the same in that case. Shall we move? Anyone, any problem? Let me know. No? Okay. Now, in this, what we have done the various legs of the working capital. Let's move to the ratios of it now. More ratios in the working capital in that case. Any working capital ratio, you're very well aware of it. Any working capital ratio, I'm sure you must have done it. Any ratio which you use for checking the liquidity. Current ratio. Do we do the current ratio? What is current ratio, everyone? What is current ratio? Have you heard about current ratio? What is current ratio? Current asset divided by current liabilities. Correct? Current asset divided by current liabilities in that case. Yeah. What is current asset, everyone? What is current asset? And for example, what we discussed, the debtors, inventory, cash, it is going to be current assets. So anything which you are looking to convert, anything which you are looking to sell within 12 months. Within 12 months, you are looking to convert. In this case, it is going to be current assets in that case. What is current liability? You are looking to pay within 12 months. That means maximum within 12 months, you are supposed to pay that thing. That's the current liability. That's the current assets in that case. What is the ideal in that case? Shivraj says is 2:1. Is it correct? Is 2:1 is the optimum mix? Is the optimum one? Current ratio 2:1, or what is the optimum current ratio? What is the optimum current ratio? Or is there any optimum thing, or nothing is optimum in this case? Okay, current ratio, everyone, is higher the better, lower the better. First of all, let's do that. Higher the better, lower the better. Okay, you can tell me this. Higher the better, lower the better. What do you think? Lower is going to be better. Why lower, Sarvana? Why higher, Shivraj? Why? And people who are quiet, give some answers. Why is this, everyone? Why the current ratio higher the better? Why lower the better? Please understand the meaning of the current ratio. What is the meaning of the current ratio? Current ratio is, this is the balance sheet. Current liabilities. That means I have to pay these guys. I have to pay these guys maximum within a span of 12 months. So I have to pay these guys within a span of 12 months. Current assets means that how much as the liquid asset I have to pay these guys in that case. Correct in that case. Vijay says higher the better. Shiva says higher the better. Cash asset to pay the current liabilities. Okay, so you're saying higher is the better. So in this case, what you're saying is I have enough current assets. Am I correct? Am I understanding it correct? You're saying I have sufficient current assets. So ideally, I should have very high number of current assets so that I can pay my current liabilities. I should have a sufficient current asset. Am I correct? Okay, that's a very valid point. Let's say there are two companies, company A, company B. Current ratio of the company A is 10, company B is 2. Which current ratio is better, A or B? Whose current ratio is better, A's or B's? A is better, B is better? A is better. Vijay, what do you think? A is better? Okay, I got everyone saying A. Shivraj, what do you think? Okay, let's say this is another company, C. Its current ratio is 50. Now, which is good, A, B, C? Okay, Sarvana. Now, tell me A, B, C, which is good? A is having 10, C is having 50 current ratio, B is having 2. Which is better? Which is the best? A, B, C? C. Parvinder says B, Vijay says B. Sarvana, what do you think? Shivraj, what do you think? So basically, what you're saying and driving in this case, highest is going to be the better. Am I correct? Whatever is the highest number, that is going to be best in that case. Okay. Higher and highest, whatever is going to be better in that case. Okay, let's see this. Let's see, this is you. You have taken some money. You have taken some money from your friend. Let's say you have taken $1,000 from your friend. Now you have to pay your friend in that case, but you don't know when your friend is going to come here to house and ask that money. So in that case, you are having right now a lot of money. You are having $100,000, but your friend says, okay, don't worry, I'll take money whenever I want the money. So you are having $100,000 in that case. In this case, will you keep on keeping the $100,000 in your hand that I don't know when the person will come? Or if I give you the option 10,000, 1,000, you can keep it with you. 50,000 you can invest in your mutual fund. 30,000 you can put it into the bitcoins, and balance of the money you can put it into the bank. Option number 1, you keep everything with you in the cash. Option number 2, you're doing all of it. Which option is better, option number 1 or option number 2? That means keeping every money in your hand, Shaker, 100,000 is good. That's the option number 1. Option number 1 is you're keeping everything in your hand and not doing anything. Option number 2 is you are keeping 1,000 here and rest of the money you are putting into these assets. Correct. Second option is good, everyone. But if that's the scenario, everyone, why are you saying highest, the capital highest current ratio is going to be good? What is the meaning of the highest current ratio in this case? The meaning of the highest current ratio here means you are keeping everything in the liquid asset. No, you're not supposed to keep everything in the liquid asset. That means you can utilize that money for purchasing the long-term asset. You can put that money into the business, but you are keeping everything so closely because I don't know when I have to pay the current liabilities. I don't know when my friend is going to come. No, that's how it does not work. You should keep a certain amount. Your friend, you need to pay 1,000 rupees. Do one thing, you keep 1,500. You keep more buffer, 2,000 in that case, but you are not going to keep the 100,000 with you. Right? If you see if you see the current ratio here, what is going to be current ratio here? Current ratio is going to be $100,000 divided by 1000. So what is the current ratio? 100. Current ratio here is going to be 100. So if I apply your logic, that means this is the best scenario, but this is not the best scenario. Why? Because I'm losing on the investments. I'm losing on the investment in that case. I could earn on the mutual fund 15%. On the bitcoins, I could earn 30% also in that case. In the bank balance, at least I'll earn 5% in that case. I'm losing everything in that case because I'm keeping it very safe in that case. Is that point clear, everyone? So that's why it's a very, very wrong notion in our mind that the high current ratio is good. No, absolutely not. It should be not too high also, everyone. It should not be too high also. Why? Because if you are keeping it too high, that means you are keeping too many current assets with you. That means you are losing the opportunity to invest in that case. What else you can do? You can purchase more machinery. If you machinery you will purchase, you will make more product in that case. The more product you will make, more sale you will do it, you will generate more profit. But you are doing everything closely. Why? Because I have to pay the current liability. That's a bad idea in that case. That's why too high is also a bad thing, because you are losing opportunity cost. Or I can say you have invested in the low return. You have invested in the low return asset. That means we should have very minimal also. No, minimal is also very risky in that case. For example, in this scenario, if you keep, let's say you're not keeping 100,000, you're not keeping 1,000, you're just keeping $100. Now this is also very risky. If you keep very less, is also very risky, because if your friend comes now, you don't have money. Now the friend will come to you, friend will say so many bad things to you, your friendship will go for a toss in that case. So keeping too low is also a bad thing. So even too low is bad. Why it is bad? Because in that case, there is a risk of insolvency or liquidation. So it should not be too high. Ideally, it should be within that range. What is that range, everyone? Whatever the industry you are into it, whatever the industry you are into it, it will totally depend on that. So depends on in which industry you are operating, that is going to be this number. We study a lot in our school and college, which is very foolish. In school, college, we learn that the 2:1 is a very good number. 1.33:1 is a number. Absolutely wrong. Absolutely wrong in that case. There is no ideal current ratio. I started with that only, that what is the optimum current ratio? No current ratio is optimal in that case. It will depend on in which industry are you operating in that case. For example, if I talk about industry like a aviation, like a cement, like a pharma, steel, metals and minings, that means I'm talking about capital heavy industry, where you need to purchase a lot of plant, machinery, you have to purchase a lot of inventory. In that case, the current ratio is generally higher. You have to keep a lot of inventory, you have to keep a lot, you have a lot of current assets in that case. But if I talk about the capital light intensive industry, for example, any IT industry, BPO, KPO, in that case, the current ratio generally is going to be lower, because you don't need that many current assets in that case. Are we good, everyone? Is the point clear? Is this point clear? Not too high is good, not too low is good. It has to be within the industry range we are into it. Okay. Let's scale the concept, right? Let's scale the concept. Let's increase the concept a bit of it. One is definitely it will depend on which industry you are working in. Second, it will also depend, I don't think you will find it in the book, you will also find it on the quality of the current liabilities and the current assets also in that case. For example, this is you and this is your customer. Customer has given you the money in advance in the year 2021, but in the year 2021 you have not done the sale you will do in 2022. In 2021 you have not done the sale. Will you book as the income? Let's say the $10,000 the person has given, will you book the same as income? $10,000. Are you going to book the same as income? No, you're not going to book the income. Is this your liability? It is your liability, right? It is the advance you have received in that case. It is the liability in that case, which we call it unearned revenue, correct? It is unearned. You have not unearned, but you receive the revenue. It's unearned revenue. It is current liability, which is $10,000. Are we good? Is that clear? Unearned income, correct? Second scenario. Let's see the second scenario. Let's see, you are running a business. In this business, what you do, current month salary, right? Current month salary, you pay it. Generally, it happens in your case also if you're working. It's not, sometimes it happens that some companies pay on the last day. Some companies pay 7th of the next month. So this month is, let's say, January. You will receive your salary on 7th February in that case. Correct? So generally, January salary you are going to get on the 7th February in that case. Let's say if I talk about the full year and I'm talking about December. If I'm making my books of accounts on 31st December, everyone, 31st December. On 31st December, have you paid the salary of December? Have you paid the salary of December? No. When will you pay this? When will you pay it? On 7th January, right? Very good. On 7th January, you're going to pay in that case. Correct? Agree in that case. So that means if I'm making the balance sheet, everyone, if I'm making the balance sheet on 31st December, would that be my liability? Yes, there is going to be outside liability in this case, which is, let's say, $10,000 again. $10,000 is the per month salary you pay in PPA in that case. This is how you have to pay in that case. If I merge both the liabilities, this is also current liabilities, this is also current liabilities. That means if in the balance sheet, if I'm writing outstanding liability, which is for salary, $10,000. Here I'm writing unearned revenue, again $10,000, which is for the advance you have received. Do you have to pay the cash here, everyone? In case of an unearned revenue, do you have to pay the cash? No, you just have to supply the material. Am I correct? You have to supply the material. Do you have to pay the cash here? Yes, you have to pay the cash here. Again, if we don't follow it properly, right? If we just close our eye and say, okay, this is 20,000. So against 20,000, I have to have the cash of 20,000. That's wrong. That's wrong, because we have to see the quality of the current liabilities also in this case, that what is the quality of the current liabilities. If we blindly follow and say, okay, no, this is not good thing, we don't have a sufficient current asset, we don't have a sufficient cash in that case, that's a wrong notion in that case. Again, in that case, we have to see the quality of the current liabilities also in this case, that in the first I have to pay the cash payment, in the second I don't have to make the payment in that case. So that will also decide your current ratio, that will also decide your quick ratio and the other ratios. Is that point clear, everyone? So the quality of the current liabilities, current assets also plays a role in determining your current ratio in that case. Okay. All right. Let's see it up to here from the book. This is something we have already done, that if the numerator is higher, if the numerator is higher, ratio is going to be higher. Same thing we have done it also in that case. So don't worry about this. Now the liquidity ratio we are doing in that case. In that case, we started with the current ratio. Okay, quickly read this page number 16. Everyone, anyone who is reading from my Shekhar, you're reading from my book, let me know. I need to scroll. Shall I move? Okay. Now, unlike the current ratio, we have another ratio in that case, right? What are these ratios? Let's understand the basic rationale of all the ratios, right? Then it's going to be very easy. Current ratio, we have understood what is the current ratio. Current ratio, we are saying this is our liability. We are saying this is our liability against which how many current assets I need in that case. That means this much of a current ratio I need, this much of an asset I need. Let's say current asset I need. That's a current asset in that case. Okay. After that, we are looking in this case the narrower version of that. That means inventory takes a lot of time. If I sell the inventory, it will take a lot of time. No, it's not very liquid. So let's see what is the lesser liquid in that case, which is called the quick assets. So basically the coming ratio, what we are discussing in that case, we are reducing the asset and we are making it narrow and narrow in that case. Is it clear? So that means if it is higher, I'm making it lesser by lesser in that case. So it is gradually going down. It's a quick ratio. Then we'll go for the cash ratio in that case. So we are gradually reducing your top numerator. We are reducing it. What is the numerator, everyone? In the current ratio, everyone, what was the numerator? Can you please tell me? In the current ratio, what was the numerator? Denominator was current liability. What was the numerator? Current asset, right? Current asset was the numerator in that case. So going forward, whatever the ratio we are doing it, we are continuously reducing few items in that case. Okay. For example, if I talk about next ratio, which is the quick ratio, exactly like a current ratio, barring few items, we are removing it from the current ratio in that case, which is called the, now it is not going to called as a current asset. It is going to be called as a quick asset divided by current liabilities. Please understand what is the rationale behind it. Don't ratify anything. Don't try to cram anything in that case. We will not cram anything. Okay. What is the quick ratio we are saying in that case? We are trying to be more defensive. See, with every ratio, we are trying to be more and more defensive in that case, right? We are saying, okay, if my friend comes, how much money I should have in my hand? How much should I have in the Bitcoins? How much money should I have in the funds in that case? So we are saying in that case, what is the most liquid funds we are having in that case? For example, if I tell you that your current liability is, let's say, $10,000. In the bank account, you are having $2,000. In the cash, you are having $3,000. In the FD, you are having $2,000. In the mutual funds, you are having $1,000. In the stocks, you are having, let's say, $5,000 in that case. You have put the money in the government bond also. Okay, not say government bonds. Let's say you have purchased some 5-year FD also, let's say in this case, which is also 3,000. So if I tell you which is the most liquid asset you are having in this case, whatever is the cash you are having in this case, correct? Second is going to be the money which is lying in your bank account. Third, you can say whatever is the FD amount or maybe the mutual fund in that case. Next is going to be the stock and this. So what are we doing in this case, everyone? Generally, if we are picking the current ratio, we will pick every asset in that case. But when we are looking for the quick ratio, we are looking if someone comes tomorrow on my door. If someone comes tomorrow on my door, what immediately I can get the money. So what is the basic rationale about the quick ratio 8? If someone comes tomorrow on your door, immediately what you can release and give that money in that case. That's the basic rationale of a quick asset. In the quick asset, we consider all the current assets minus we don't consider any inventory. We don't consider any kind of a prepaid expenses also. That's going to be quick ratio. Another formula for the quick ratio is going to be cash plus the short-term investments plus it's going to be debtors. Balance will remain always current liabilities. Let's see it. This is also called as a asset test ratio. This is what is also called as the acid test ratio. Let's see. Quick ratio, also known as the acid test ratio, is similar to the current ratio, except it excludes the inventory and includes the more liquid current assets such as cash, short-term marketable security, and receivables. A higher quick ratio implies the more liquid current assets are available for making the current liabilities payment. A shift to the less liquid or an increase in the current liabilities will decrease this ratio, obviously, in this case. So how you're arriving at the quick ratio? Cash and the cash equivalent plus the marketable securities plus the receivables in that case, all of it is going to be called as a quick asset in that case. Again, is this ratio higher the better, lower the better? This ratio higher the better, lower the better? What do you think? Again, same here. Too high is also not good. Reason being, you are putting the money into the less investable asset in that case. Lower is also not going to be a good thing because there could be a risk of the liquidation in that case. As we discussed, it has to be in a particular range in that case. Whatever works for your industry, that would be the ideal range in that case. Same in that case. For example, if you see this year, in the first year, it is 0.7. In the second year, it is 0.61. Industry average is 0.81. So that means earlier you were very close to the industry average. Now you have reduced that amount. So ideally, you should come near to the industry average in this case. Cash ratio, as we said, as I said in this case, the assets are reducing. The assets are reducing in this case. So first it was the current assets, then it was the quick assets, then it is narrowing it down to the more in this case. Cash ratio, we'll call it the CR2 because CR we are already using the current ratio. So let's call it the CR in that case. Here we are considering cash plus marketable securities. We are not even considering the debtors, which we are considering in case of a quick ratio, but we are not even considering the quick ratio here in this case. Here we are thinking that what about the creditors come on my door the next morning? What is something I can immediately give him? So obviously whatever is the cash lying in your house, you're going to give that. Any marketable securities which you can sell it and give it to the person, that's going to be the most liquid in that case. Last is going to be the operating cash flows in that case. I think this is something I'm going to cover it later, operating cash flows, because I have to discuss with you the entire cash flow statement. Working capital, entire working capital divided by the total assets in that case. That's going to be the net working capital in this case. Okay. Let's see every scenario one by one. Just allow me a minute. If you have collected accounts receivable, everyone, accounts receivable, if in your balance sheet accounts receivable were appearing, right? Let's say it was appearing $10,000 and you have collected that. Would it going to change your current assets? Is it going to change your current assets? Yes. Is it going to increase your current assets or decrease your current assets? Or no change in the current assets? Decrease. Why? Is cash not the part of current asset, everyone? Is cash not the part of current asset? Correct. There's not going to be any change. See, understand. Receivables will go down, correct? But the cash will increase in that case. Net impact is going to be zero again in that case. Is it clear? Everyone? correct, debtors has converted into the cash. So eventually there is not going to be any impact in this case, in that case. So is your current ratio going to change, everyone? Is your current ratio going to change? No, no change in the current ratio in that case. Okay. Let's say you have correct, Shekhar, but what is the point then? It might be bad debts, but we are talking about the treatment of this statement only. You're right, it could be bad debts also, but it does not matter here. Let's say you have purchased building. You have purchased building with cash. Is it going to change your current asset? Is it increasing or decreasing the current asset or no change? Is it going to increase or decrease? Decrease. Correct. Cash will go down. Correct. This is going to decrease in that case. Okay. Let's say you have purchased on credit. Everyone, you have purchased on credit. Is it going to change your current asset? Is it going to change your current asset, Parminder? If you purchased on the building on credit? No, I'm talking about current asset. Current asset. Current asset, again, no impact on that case. Again, that will also depend the building, how we are purchasing. It could be sometimes building purchase could be sometime long term also. It's not necessary the short term only in this case. Correct. Okay. Let's say you have purchased the inventory, everyone. You have purchased the inventory in cash. Is it going to change the current asset? No. No impact. Okay. If you are purchasing on credit, everyone, is it going to impact? If yes, what? Increase or decrease? Is it going to increase or it is going to decrease? It's going to increase in that case. Correct. All right. I think we'll stop it. Do we have any questions, everyone, from what we have done today? As we'll quickly devise whatever we have done it. Any questions? No? Okay. Let's quickly revise, everyone. This is not my revision. It is your revision. So everyone, please be involved in that case. How many statements we have done? We have done 3 statements. In that case, first statement is going to be P&L, second is going to be balance sheet, third is going to be cash flow statement, right? We discussed every item is going to be for the full year, be it the P&L, be it the balance sheet. In that case, cash flow statement is be it the cash flow statement, be it the P&L. The balance sheet is something we make it as on date. And what is that date? It is the year end. It is something which is going to be year end in that case, right? So that is something which is going to be year end in this case. Current, we discussed that in US, we generally follow the calendar year. In that case, that means generally we are going to use the calendar year, 1st January to the 31st December. We are not going to use the financial year. We are not going to use the fiscal year, which is the ending on the 31st March. We are not going to talk about that. We talk about this. We talk about that the balance sheet of P&L is also says as a P&L is also say as the income statement of the earnings. Balance sheet is also called at the statement of the position in that case. This is the basic format we have done. Sales minus COGS. We'll get this the gross profit. From that we are going to reduce the SG&A. We'll arrive at the EBITDA. From the EBITDA we are going to reduce the depreciation. We'll get the EBIT. From the EBIT we are going to reduce the interest, then the PBT, then the tax, and then eventually we arrive at the PAT in this case. We discussed that COGS is something which is going to be pure and pure manufacturing expenditure. SG&A is something which is going to be non-manufacturing expenditure in that case. So any salary which you are paying to the sales staff is going to be SG&A. Any salary you are paying to the manufacturing staff, it is going to be COGS in that case. What is the formula for the COGS, everyone? Quickly, what is the formula for the COGS? What is the formula for the COGS? Sales minus gross profit, easier one, Shekhar, you told me. What is the bigger one? Opening stock plus the purchase plus the manufacturing expenses reduced by the closing stock, right? That's going to be your COGS in that case. We discussed that just to do the financial statement analysis, we do the various methods in that case, for example, ratio, graphs, vertical income statement. In the vertical income statement, everyone, what is the thing we use for the purpose of conversion? What is the base for us for the vertical income statement? For the vertical income statement, what is the base in which we use for converting into the percentage? In the vertical income statement, what percentage of that we convert? Percentage of net sales, correct. Percentage of sales we do in that case. What about in the balance sheet? In the balance sheet, what is the base we take for the purpose of conversion? Total assets. We take it the total assets in that case. We talk about this. We talked about this. Horizontal, we are talking from the year on year, we look in that case. That means we take it as a base in that case, and then we see how much is the performance change from the base year in that case. Then we talk about the annual in that case. Then we talk about the annual in this case, that how much the annual growth has happened in that case. That is we call the growth rate, annual and annual in that case. Working capital, we talk about the working capital. Basically, the three elements we are going to look into this. First is going to be accounts receivable, which is the debtors turnover ratio. Second, we talk about the inventory, which is going to be the inventory turnover ratio. And lastly, it is going to be CTR in that case. Debtors turnover ratio, we discussed, it is going to be credit sales divided by the average debtors in that case. This ratio higher is going to be better. That means how many times you're churning your sales, in that case. We do the average because in the numerator we are taking the full, in the denominator we are using the average in that case. Number of days is going to be lower the better in this case. Lower the better is going to be better in this case. Then we talk about the inventory turnover ratio. Inventory turnover ratio, again the higher is going to be better in that case, which is the COGS divided by the average inventory. COGS divided by the average inventory. In that case, we can't use the sales in that case because inventory we don't value on the sales in that case. Again, this ratio is going to be higher. Number of days, number of the inventory days, this number is going to be lower, again a better. That means higher number of the circles, and the days, the smaller the circles we are talking about in this case. Lastly, we talk about the creditors turnover ratio. Creditors turnover ratio, again this ratio is going to be lower the better, and the number of days of the creditors days is going to be higher in that case. If I add the debtors days and if I add the inventory days, what do I get? Debtors days plus the inventory days, everyone, what will I get? Everyone, quickly. Debtors days plus the inventory days, what will I get? We'll get operating cycle. We'll get the OC in that case. Very good. You can share it to the group also, Parvinder. We are going to get the OC in that case, right? From the OC, if we reduce the creditors days, what will we get? That means debtors days plus the inventory days minus the creditors days, what will we get? C3. We are going to get cash conversion cycle. C3, we are going to get the C3 in that case. Is it possible that the C3 can be negative? Is it possible that C3 can be negative? Yes, it is possible. Is it good, bad, ugly, very good? Is it good, bad? It's very good in that case. It's a very good thing for you because that means you're funding. That means your creditors are funding your debtors, your debtors and the inventory also in this case. Yes. We talk about this. Then we talk about the few ratios also. In that case, we talk about the current ratio. We talk about the current ratio. Current ratio is going to be current asset divided by the current liabilities. In that case, we discuss too high is not going to be good. No ideal ratio in that case. That means 2:1, absolutely wrong. 1.3, 2:1, absolutely wrong in that case. Ideally, range has to be within the industry wherever you are operating. In that case, we discuss if it is a capital intensive industry, that means capital heavy industry. In that case, it is generally going to be higher. In case of it is a capital light industry, generally it is going to be lower in that case. Ideally, it should fall within that range. Not too high is good, not too low is good. Not too high is good because that means you're losing the opportunity of putting the money into the investment in that case. Too low is also bad in that case. That means that you're running the risk of the insolvency in that case. It has to be in medium. It has to be in that range. Absolutely correct in that case. After that, we discuss the few Other ratios also we discussed the quick ratio also in that case, quick ratio and the cash ratios in that case. We talk about not only in the range important, but other the quality of the current assets also. Current assets and the current liability will matter in that case, right? We discussed the example of the unearned revenue and the outstanding in that case. Outstanding, we have to pay the money out of our pocket, but in case of unearned, we don't need to put money in that case. So again, the quality of the current liabilities also matter in that case, how much we need to keep in this case. Current asset, as we keep on narrowing it down, that will give us the different ratio. For example, current ratio is going to be current asset divided by the current liability, current ratio in that case. Quick ratio is going to be current quick ratio, which is also called the asset ratio, which is the quick asset divided by the current liabilities in that case. That means cash plus the marketable securities plus the debtors in that case. Or if I talk about the current from the current angle, current asset angle, it is going to be current asset minus the prepaid expenses minus the inventory. You will get the quick assets in that case. Again, this has to be within that range. Last ratio in that case is going to be the cash ratio. Cash ratio is going to be cash plus the marketable securities divided by the current liabilities. This ratio again has to be the most liquid asset. We are going to talk about this. Everyone, please revise whatever we have done it. Would be very helpful, because especially on the current ratio side, whatever we have done it, please read that. Why I am saying so, because tomorrow I would need that a lot. So if you have not revised it, that would not be very helpful. So please revise, especially what we have done regarding the current ratio, current ratio, quick ratio, cash ratio. I will need that tomorrow, right? So it's, you will understand it much better if you have done the revision in that case. Would be very, very nice in that case. All right. Thank you so much for your kind words, and thank you so much for your energy. I'm looking forward to meet you tomorrow. All right. Bye-bye. Sure. That's okay. All right. Thank you so much. Bye-bye. Good night.